Hey everyone, this is Nick Dearbertis teaching you financial modeling. Today we're going to be talking about enterprise value and equity value in the context of the DCF model. This is part of our lecture series on the discounted cash flow valuation, focusing on the cost of capital side of the model. So we already gave a quick introduction of the DCF, and now we are getting into the enterprise value and equity value portion of the model. So in that, we have to disentangle what is enterprise value versus equity value. So the enterprise value is the value of the entire business. And so you can think of it as the value of the assets in terms of the basic accounting equation: assets equals liabilities plus equity. So it's the whole asset side, and so that means it's also liabilities plus equity. Or you can think of it as the acquisition cost. So if you are someone that wants to purchase this entire company and own it outright, this is how much it would cost you to purchase that. So in terms of the formula that we can use to define the enterprise value and relate it to the equity value, we have that the enterprise value equals equity value plus debt value minus cash. And then what is the equity and debt value in here? So the equity value is just the value from the stock side of the company. So going back to assets equals liabilities plus equity, you got to finance your assets with either borrowing money, the liabilities, or issuing stock, the equity side. So a company that only issues stock and never issues debt, their all their assets are going to be financed by equity, and so all of that is going to be an equity value. But if a company has borrowed a lot of money to finance their assets, then the debt on the balance sheet is representing the debt value in the company. It's the value of the bonds and loans, whatever instruments they use um, to finance their assets. So we can use this same formula to back into the equity value. You do a little bit of algebra, flip this, and we would have equity value is equal to enterprise value minus debt value plus cash. And that's what you can use in the DCF model to back out the equity value. Where a lot of students struggle with this definition is the fact that we're subtracting cash here. You might think, well, cash is a good thing, so shouldn't it add to the value of a company? And in order to help understand this, I like to think about these two possible ways that we can conceptualize the enterprise value, asset value, or the acquisition cost. And within each one, there's a way we can understand why cash is actually being subtracted to determine the enterprise value. So under the asset value kind of interpretation, that the enterprise value is representing the stockholders' value as well as the value of the loans. So for that, we can think about two hypothetical companies which have the exact same operations. They produce the same cash flows. Everything is the same about these companies, even their capital structure and everything. And so they have the same exact enterprise value right now. Now, say that one of them says that I'm going to go issue $10 million worth of stock. And so they issue the stock and they get cash in return for that stock. So now they have 10 million additional dollars of equity and also 10 million additional dollars of cash, the asset side. And so the balance sheet still balances, right? But if we said that cash should be adding to the enterprise value, well, then we would be adding 10 million for the equity value, and we would again be adding another 10 million for the cash on the balance sheet. So now, even though these two companies are still exactly the same in terms of their operations, one just decided to raise money and just hold it. All of a sudden, it's worth $20 million more. That doesn't make sense. But if the cash actually offsets the value of the equity that they just raised, they get $10 million of equity, but they also have $10 million more of cash. Then it washes out, and the two companies still have the same value. So that makes more sense. Now, if the company took that cash and deployed it into assets that are going to create value for the company, then it can come back into the enterprise value. But they have to actually use that cash for something useful in order to increase their enterprise value. And then the other way we can think about this is in terms of the acquisition price, how much someone would have to pay to own the company outright. So in that, you can think, well, in order to own the company outright, they have to buy out all the stockholders, but they also have to buy out all the debt as well. And so that's why these two are both getting added in. But then after they bought the company, they have the cash from the company now in their possession. And so that actually reduces the cost of acquiring the company because they have that cash coming back to them. So either of these ways that we can conceptualize the enterprise value, in both ways, it makes sense for cash to come negatively into the equation. So that's how we can disentangle the enterprise and equity value. And basically, as you complete the DCF model, you'll take the present value of all the free cash flows at the discount rate of the WACC, and you'll be left with an enterprise value from that. So then you can just reverse that formula to back out the equity or stock value in order to get to the stock price. So that's enterprise value and equity value. And then the lab exercise on this. There are two different exercises involved here. So this first one, you have some cash flows here, and you're basically trying to figure out what is the enterprise value. You have cash flows, and you also have a weighted average cost of capital. And you want to get ultimately to both the enterprise value as well as the stock value. So you can reverse this formula to get to the equity value from the enterprise value. And then if you divide the equity value by the number of shares outstanding, you'll be left with the stock price. So that's the first exercise here. And the second one is similar. We're also trying to get the enterprise value as well as the stock value with a slightly different situation. So that covers enterprise value and equity value in the DCF model. Thanks for listening. I'll see you next time.